Hey everyone, welcome back to Corporate Decoder. Today we are diving into a company's moves that might seem a bit hidden, like a secret handshake in the corporate world. Let's see what signals are we getting from this report. Before we dive in, if you like getting easy to understand breakdowns of these important company documents, hit that subscribe button, and for more insider chat and to join our community, check out the Discord link in the description below. Alright, let's get straight into it. This isn't your typical super detailed financial report, but it is still important because it tells us about some key actions the company is taking. Think of it as the company announcing a big deal or a significant change. Our focus today is on CNL Strategic Residential Credit Incorporated. We're looking at an 8K filing, which is essentially a way for companies to announce major events that shareholders should know about right away. The date of the earliest event reported here is the 29th of January 2026. First off, there is an announcement about entering into a pretty important agreement. Now, the report directs us to another section for the juicy details, so we'll head there next. This is like a movie trailer telling you to stick around for the main plot. This is where things get interesting. On the 30th of January 2026, a subsidiary of CNL Strategic Residential Credit called Arcred Craftsman Administrator LLC basically inked a deal with Goldman Sachs Bank USA. This deal is called a Master Repurchase Agreement. Now, what does that mean for us regular folks? It is a way for the subsidiary to get funding, up to a whopping $400 million. They're using eligible loans as collateral to get this money. This is a significant chunk of money. It means the company is looking to expand or finance new acquisitions using existing assets as a way to borrow more cash. The interest rate on this money is tied to something called term SOFR plus a margin. Basically, it is a floating interest rate that will change over time. The agreement is set to last until the 30th of January 2028, unless things change. Now, here is a crucial part for the parent company, CNL Strategic Residential Credit. They've provided a guarantee for this deal. What this means is they're essentially backing their subsidiary's loan. If the subsidiary can't pay, the parent company might have to step in. The guarantee could become fully their responsibility if certain bad things happen, as outlined in the agreement. This is a risk for the parent company, so it is definitely something to keep an eye on. Moving on, the company also announced a closing for a private offering. They issued a good number of shares of Class E and Class A common stock. They sold these shares at $25 each, bringing in about $24.5 million. This is called a private offering because it is not available to the general public on a stock exchange. It is typically sold to a select group of investors, and in this case, it is exempt from registration requirements under specific rules. So, they raised about $24.5 million from selling these shares. What is interesting here is that they didn't pay any selling commissions or fees for these specific classes of stock. Part of the investment came from the company's advisor and another affiliate called Baalbek Capital Holdings. They each put in a substantial amount, showing confidence from key players. Next up, we have a declaration of distributions. This is essentially the company announcing that they will pay dividends to their shareholders. Specifically, they declared a distribution on their Class E and Class A common stock. They're setting an annualized distribution rate of 8.0% based on the offering price of $25 per S-share. It is important to remember that this is an annualized rate and not a guarantee of future performance or payouts. The actual sources of these distributions will be detailed in their regular financial reports. They've laid out the schedule for these payments with record dates and payment dates. For February 2026, the declared distribution is $0.166667 per S-share for both Class E and Class A stock. This shows the company is returning capital to its investors, which can be a positive sign. Finally, we get to the exhibits. These are the actual documents that back up the announcements. Here we see the Master Repurchase Agreement with Goldman Sachs, the big funding deal we talked about. And here is the guarantee provided by the parent company. These are the key documents that provide the legal details for those transactions. The report is signed by Chirag J. Bavsar, the Chief Executive Officer, on the 3rd of February 2026, confirming the company's official acknowledgement of these events. Now, let's look at the bigger picture here. CNL Strategic Residential Credit is actively securing significant funding, up to $400 million through a repurchase agreement with Goldman Sachs. This indicates a strategy of leveraging their assets to fuel growth, likely in acquiring more residential credit assets. The fact that they're using a subsidiary for this and the parent company is providing a guarantee shows a structured approach, but also introduces a risk for the parent if that subsidiary falters. Simultaneously, the company is raising capital through private share offerings, bringing in another substantial amount of cash. This diversified approach to funding is a strength, allowing them to expand their operations without solely relying on debt. The premium pricing of $25 Per S. Hare suggests investors see value in their strategy. The declaration of distributions, while modest, signals a commitment to returning value to shareholders. This can be a positive signal, especially for income-focused investors. But it is crucial to track the sustainability of these distributions against the company's actual performance, which we'd see in more detailed financial reports like a 10Q or 10K. Looking at the risks, the main one highlighted here is the guarantee. If the housing market or the specific loan portfolio experiences significant distress, CNL Strategic Residential Credit could be on the hook for a large sum. It is like a parent co-signing a loan for their child. If the child can't pay, the parent is responsible. Overall, CNL Strategic Residential Credit appears to be in an aggressive growth phase. They're strategically using debt and equity to expand their portfolio. The key for investors will be to monitor how effectively they deploy this capital, manage the associated risks, and how their underlying loan portfolio performs. Without seeing the full financial statements, it is hard to judge the depth of their financial health, but these actions suggest a company that is actively pursuing expansion opportunities. Alright, that is our breakdown of CNL Strategic Residential Credit's latest filing. What is your take on these moves, and what do you think this means for the company's future? Let us know in the comments below. If you found this analysis helpful, please give it a thumbs up and subscribe for more dives into corporate filings. And don't forget to join our Discord community, linked in the description, for more great discussions. Thanks for watching, and we'll see you next time.